The viewers here on YouTube are always looking to find stocks with future growth potential. Every great investor will do a great job finding that. We use our Everything Money software to find stocks that are potentially undervalued, but small enough to have a lot of future growth potential. As you know, in order to find multi-baggers, not only do you have to find companies that are great at compounding, they have to have a lot of runway left to allow them to really expand in that growth. Stock number one, Sprouts Farmers Market. Guys, this is a company that I own, and it makes me chuckle. Now remember, don't buy any stock because I or anybody else on the internet does it. I'm here to teach a process that you can apply to your own investing. I don't care if you're Jimmy Buffett or Warren Buffett. The goal is to find the right process for you. Sprouts has absolutely killed it. Now, not gonna lie, I was buying it from $32 to $35 a share. So I've killed it. With that said, I did not get my full position. It just skyrocketed from there. But this company has absolutely crushed it. Let's take a look at some high-level numbers. First off, $14 billion market cap compared to a $16 billion enterprise value. The difference there, guys, is essentially their net debt. So this is a company with a very reasonable debt amount. So guys, this is screaming expensive here. It's 48 times 5-year free cash flow, 40 times its current free cash flow. But wait, it might not be that expensive. I'm not saying it's not. For me, I own the company, and old Paul would have said, I'm going to sell this because I feel it's run up too fast and move on. But new Paul says, listen, let your winners run. Let a great company that's executing continue to execute instead of getting in and out, in and out, in and out. And I've done that several times in the past, and I've regretted it every single time. Now, Sprouts is an amazing story. Literally overnight, this company has led the execution that's made everybody on Wall Street absolutely love it. Investment banks have been piling in and also raising their price targets. Sprouts is actually a top 5 holding by weight in the Russell 2000 index. And guys, their attention is absolutely warranted. It posted 8.4% same-store sales growth in the most recent quarter. As a comparison, Kroger did 1.6% in the third quarter. Sprouts also has a 38% gross margin versus Kroger at 22%. What does that mean? It means every unit they sell has 38% going to pay their overhead and get to their bottom line profit, while Kroger's at 22%. Guys, these numbers are not only incredible, they're getting better because the company has grown to 428 stores in 23 different states. And with all their new stores are being built, they're 23% smaller in square footage. So they're packing in revenue on a much smaller basis, being much more efficient. Now, also, don't forget, they have their own brand that has much higher margins of 50 or 60% versus the 38%. And that is a percentage of the revenue is growing. So this company, their goal is to basically triple in size. So they have the growth in terms of expansion, number of stores, and they have the growth in terms of gross margin as well as net margin, compounding on itself. This company really has a lot of growth potential. Now, let's see what analysts think. I don't remember what analysts think about this company, which goes to show you how much I don't care. 340 to 347, which boggles my mind. Over the next 4 years, they expect basically flat earnings per share growth for the company. I don't know what they see. Because interestingly enough, they have 10, 9.5, 10, 5.5, 5.5% revenue growth, taking their revenue up to $10 billion, yet earnings per share being flat. I don't know why that is. But remember, I look at this and it's okay to be different than analysts because analysts have their own bias whenever they're looking at a company. So of course, it leads us to our last point, which is what does the stock analyzer tool say? Well, remember guys, we use the stock analyzer tool to give a low, middle, and high range on our assumptions of revenue growth, profit margin, earnings multiple, as well as our desired return. This allows us to give this range because it's going to give us a range of values. As an investor, we don't know the future, and we're humans and we make mistakes. That's why we need to make multiple different estimates when we do our stock analyzer tool. Now, I'm doing a 10-year analysis here, and again, you can do up to 20 years on this company. I did 6, 8, and 10% revenue growth. I did 4, 4.5, and 5% profit margin. Guys, I could argue this is very low for free cash flow and profit margin because as they grow, they're going to make more efficient decisions, decrease their costs overall, as well as increase the percentage of revenue coming from their own in-store brand, which has much higher margins. I could see this being 5, 6.5, and 8%, but I'm sticking at 4, 4.5, and 5. PE, what's the PE and price of free cash flow? in year 10. I put 16, 19, and 22. Only because by that point, they're a mature business and they're a great business, but they don't have the growth expansion that they do today. And finally, I did a 9% return. You're going to see me put 9% in for everything. This has no margin of safety. I put this in because the historical average is 9 or 10% on stocks. So I'm sitting there saying, what's it worth today based on getting the stock market return? But again, I don't want the stock market return. On individual companies, I want margin of safety. So I hit the analyze button. Guys, I have a low price of 60, a high price of 120, middle price of 85. So it's well above my middle range. But again, I'm not here to jump in and out of great companies. I'm going to sit here and stick with it, even though it's much lower price than today based on my intrinsic value. Stock number 2, guys, Go Easy. They're an installment lender. And I'm going to go over this. This is on the TSX, on the Toronto Stock Exchange. Has a $3 billion market cap. Big enterprise value though, 6.45. So a lot of difference here. And their free cash flow was $455 million in the last 12 months. It's a big jump compared to the last 5-year average, which is negative. So from a 1-year perspective, they're selling for 7 times free cash flow. The question is this sustainable? They paid a dividend of 2.5% for next year, 2.1 this year. And they can afford that. It eats up $61 million of their $450 million in free cash flow. The first thing I'm going to look at, guys, is why was their 5-year free cash flow so low in the negative? Let's go to their cash flow statement. And it actually looks pretty consistently negative. 70, 74, these are negatives. Negative 30, positive 125, negative 230, negative 170, positive 45, negative, negative, negative. And the last 12 months, they've done $120 million in profit. They're an installment lending company, which means their typical customer they service has not enough bad credit to need a payday loan, but also not good enough to obtain loans from banks and other higher end institutions. The company has vastly outperformed the market in its history. It hit a low of $26 or so in 2020. And since then, it is basically up 5 times since then. I mean, look at this, $181. It's actually skyrocketed even more than that. It's actually 6 or 7 times more now. Since 2019, they have compounded at over 20%. Loan growth of 35%. And ready for this one? An average interest rate of 30.3% charged to their customer. Go Easy currently has 400 locations across Canada, making them absolutely front of mind with their customers, given the physical number of stores. So the difference between Canada and the US is, in the US, anybody can buy credit data about any customer they want. In Canada, that personal privacy is way more strict. So the only way to get that data is to write and compile the loans yourself. And guess what? That's what Go Easy has been doing for decades. So the more loans they write, the more data they get, and the better they underwrite. Even better, the former CEOs and board chairman, Don Johnson and Dave Ingram, they own 20% of the outstanding stock. So you might sit there and say, well, why does that matter? Well, guys, we love when individuals own a big chunk of companies. Why? Because you better believe they want to become even richer. So they're going to sit there and put their money where their mouth is, and they're going to sit there and do the right things for the company because their net worth is tied up in that. Now, guys, here's the 10-year chart, just to show how this company, when you're sticking with companies, big surge, fall back down, big surge again. This is the thing you have to remember. When you find great companies at great prices, they're going to have their falls. The question is this fall dramatic or not? This is why we're teaching on this channel. The idea of buying a company is buying a piece of a business. And sometimes the market can overvalue the business, and sometimes it can undervalue it. And I'm not saying this is overvalued, this is undervalued. But look at every great company in history. There's a great book written about 100-baggers. And in there, Christopher Mayer, the guy that we actually interviewed, talks about the fact that you have to absorb big drops in stock price as this company goes to 100x. That's hard to do. It's hard because the emotional side of investing. You're sitting there and you see a stock go up. Then you feel so great. Then you see a stock fall. Look at Sprouts. Sprouts is at 140 and everybody's seeing it go up. And I'm like, okay. In my head, I don't think it's a $140 stock, even though the market's telling me it's that. In my head, I think it's an $80 to $90 stock. I want you to attach yourself to the value of the company, not the price listed by the market. And that's a very tough thing to do. But that's what we're teaching on this channel. That's what we do in our community. That's why we have these tools. The stock analyzer tool is for exactly that reason. Because if a stock is selling too expensive, you can go, okay, even though it's at this price, it's probably not worth that. And if it's really cheap, okay, even though the market is selling at this price, it's probably worth more. Because remember, price is what you pay, value is what you get. Now, If you've gone to our website to join our community, you're going to notice we've had a waiting list. Today's software includes everything we offer in stocks, retirement, and even real estate. But we're making changes behind the scenes, so that offer is absolutely going to go away very soon. Now, if you remember from the beginning of this channel, I built this software selfishly for myself so that my team and I could use it to continually make better decisions in our investments in stocks and real estates and make the right decision for my future self in retirement. But we've grown a ton. It's less about me and more about how I can better serve you now. And this is why we've updated our software to give exactly what you need. Now, the good news is we haven't made these changes yet. They're still being worked on behind closed doors. So if you join today, you'll be grandfathered in for life with everything because this is the best deal that we've ever offered. Now, I'm telling you this now because there's still time for you to sign up. As long as you join Everything Money today, before we make these changes, you can keep your plan even after the changes are made. You will keep all of these tools that we've made that you're included. And on top of that, you will stay in your pricing tier forever. So click on the link in the description below or go to everythingmoney.com/signup and get access to everything we have to offer, including all of our investing tools and community. And I'm quite sure it'll be the best investing decision you made in your life. So guys, when it comes to our stock analyzer tool, it's a lender. We've had jokes with people saying CFOs don't even know what free cash flow is. So I'm going to ignore free cash flow here. I'm going to put it in here just because I have to, but I'm going to ignore this completely. I'm going to focus on profit margin and the price based on those profit margins and the earnings of multiple of earnings. So first, guys, the 10-year analysis, I'm doing revenue growth of 7, 10, and 13. Now for profit margin, again, the one we have to focus on, I'm going to do 16, 18, and 20. Now, guys, in the last 10 years, they did 16. So I think it's a reasonable number because you see it skewing up here. And it's gotten a lot higher since then. So 16, 18, and 20 still might be conservative. And again, even though I say ignore it, I'm putting the same thing in for free cash flow because I have to put something in. Now, PE. Current PE is 12.5. I'm assuming, just to be conservative, I'll stick with that 12. I'm going to do 12, 14, and 16. Same on free cash flow multiple. And again, my 9% desired return. Now, guys, if you really want to look at this company, like for me personally, I'm going to put in a much higher number here. I'm going to be putting in like 14, 15% because you know why? I don't get banking. I don't understand it. It's not in my circle of competence. But if the numbers still work, I'm going to go in the community and find somebody who is smarter than me in banking. And there's a lot of people out there. So I hit the analyze button. Guys, look at this. A low price of $212, a high price of $493, a middle price of $325. Based on today's price and my middle assumptions, that's a 17.5% compounded growth rate on 10 years. So in my opinion, it's worth a deeper dive if you feel comfortable with banking. And guys, if you're in our community, reach out to Dalton. He's Wicked Willie in the community. You guys all know him. He works on the channel. He owns the stock, but again, don't buy because he owns it. But he'll talk you through your analysis, his analysis of it to get you to understand it better from his perspective. Guys, stock number 3, another stock that I own. Again, the disclaimer, don't buy anything because I own it. Paycom Software. I got very lucky. This stock fell hard to 150 or so back in July. I picked up some shares, not as much as I'd like. It's currently at 231. Guys, it's up 32% in the last 6 months. 46% in the last 3 months, 41% in the last month. It has really surged as of late. This company has a $13 billion market cap with a measly $14.5 billion enterprise value. Now, one thing I don't like, the free cash flow is trailing the net income here. 1 year is 305 versus 470, 5-year free cash flow of 220 million versus 280. So that's something to consider here, but great returns on capital. 82% gross profit margin with a bottom line of 21% in the last 5 years, 26% last year. Now, Paycom has almost 37,000 clients, and it focuses its products on hiring, engaging, payment, management, and tracking of employees. Now, they stated in their last earnings report that it wants to get to the point where all the redundancies of running and operating your business are fully automated. And guys, as a business owner, I can't tell you how much I love that idea. Their CEO claims that they're already the most automated offering in their entire industry. Now, to demonstrate the strength of its product offering, Paycom actually conducted a study showing that its automated processes returned an average of 821% return on investment over a 3-year time frame. 821%. In addition, they have an offering called Gone. And on average, that saved organizations 10% in labor costs that would typically go overlooked or mismanaged. Guys, think about a small business that has a few employees. And let's say they have $200,000 in payroll. That's 10% at $20,000 a year in savings. How much would you pay as a business owner to get $20,000 per year in savings? This is exactly why their customer retention is so high, clocking in at over 90% at the end of 2023. The business is incredibly diversified, with no single client making up a single percent of revenues, and 0.5% at most. Remember, if you go to these 10Ks and you see a lot of these companies, they're going to sit there and say, hey, one of our risks is we have a client that makes up 18% of our business. Not a single client makes up 0.5% of their business. So guys, let's see what analysts are saying about Paycom. Look at this growth. $8 per share this year in EPS going to $13.77. That's double digit all across the board. Let's look at their revenue growth potential. 11%, 11%, 11%, 14, 11%, going from $1.9 billion to $3 billion. Guys, let me ask you this question. Based on what you're seeing here, the number of clients they have and the growth potential worldwide, do you think this company is going to be bigger 10 or 20 years down the road? The answer is probably yes, both in revenue and profit and free cash flow. So the question you ask yourself is, what's the reasonable price to pay for the company? And that's why the stock analyzer tool is so useful. I like to focus my investments on companies like this that have growth potential, or they're so big they're not going away, or a combination of both. That way I just realize it's just about paying the right price. I have to be patient. So the last time I did Paycom, let's see what assumptions I made here. Okay, I did a 10-year analysis. I did 6, 8, and 10% revenue growth. And keep in mind, guys, way lower than the last 5, 10, and even last 1 year. But I'm okay with that. Profit margin, I did 20, 23, and 26. Lower free cash flow, and I'm okay with that. PE, because of their high return on invested capital, I put 17, 20, and 23. Remember, this high return on capital tells us that they get a good return on compounding their money, and that's what you want to pay a premium for. It also tells you there's kind of a moat happening. Now, it's not Apple's return on invested capital, but it's pretty solid. And again, the 9% desired return. Hit the analyze button. The stock's currently at 232. Low price of 120 to 135, high price of 270 to 300, middle price of 180 to 200. Now you see why I jumped on it sub 150. Now guys, if you want to see a next video on top undervalued stocks, check it out. Thank you for your time.